Hello, great talks. Today we're looking at accounting paper 1 that was written in November 2023, and we'll specifically be looking at question 1, which is comprised of company financial statements, and it was allocated 55 marks to be completed in 45 minutes. So we're given Boucle Limited. The information relates to the financial year ended on 28 Feb 2023. Now the business sells bicycles. So we know that our year began on the 1st of March 2022. So the first required, we are then required to refer to information B Roman figure 2, and then we are supposed to calculate the value of closing stock of bicycles using the FIFO or the FIFO method. So here we're calculating the value of closing stock of bicycles. Okay, let's look at the information that we're given. So B, adjustments and additional information. Roman figure 2 says the following information was obtained after the physical stock count. So the first in, first out method was used or is used to value the stock of bicycles. Okay, so here we're given the table for the purchases for the current year as follows. So we had purchases in June, September, and Jan 2023. And then we're given the number of units. We are also given the value per unit and the total value of all these units. Then under the note, there were 1009 bicycles. Okay, there were 1009 bicycles on hand on 28 Feb 2023. We know that's our year end. And then 40 bicycles purchased in Jan 2023 were returned to the supplier. So 40 bicycles, right? So 40 bicycles that were bought here were returned, which means we're supposed to decrease our number of units there to 40. And then the last one says a number of bicycles were stolen. It must be recorded as a loss. Okay, so we know here we have a loss, which alludes to our trading stock deficit. Then now looking at the information on our note and using the FIFO method, we know that we had 1009 bicycles at the end. So using the FIFO method from the 740, okay, we know that the 1009 is comprised of the 740 that was bought in Jan, but remember that we need to subtract the 40, therefore we only have 700. And then the second part that will make up to the 1009 is 1009 minus the 700 that we have, which is 309. Now the 309 units will come from the September units. Okay, so the 309 comes there. So the value of stock, we have 700 units from Jan that were bought, and their cost was 2,100 per unit. Okay, so that's 2,100 per unit plus the 309 units that were bought in September. Okay, and the cost per unit is 2020, so that's 2020. Okay, then now we are gonna calculate our value plus 309 times 2020, and then that's 2,094,180. Okay, then that's the value of our stock, and that's the value of our closing stock. Okay, but when we look at our inventory that we were given from our trial balance on information A, we were given trading stock here of 2,125,000, but now when we calculate, we're getting 2,094,180. Okay, so this amount is definitely less than that, and that is the trading stock deficits that they were talking about. Okay, so because we can see that now we are supposed to complete the statement of comprehensive income, rather, we can just fill in the trading stock deficit because we already know what's happening. So we have the trading stock deficit here, and then we get the difference between the two amounts. So this other one is 2,094,180. Then let's quickly check what we had before. So it's 2,125,380. Okay, so remember that whenever you're completing your statement of comprehensive income or your statement of financial position, take it as a puzzle. You don't necessarily have to complete it in order, but you have to just do as the information that you're given is concerned and in that order. Okay, so we are just going to start at the start, okay, or at the beginning of the statement of comprehensive income, whereby we have our sales and cost of sales. So we're given sales here, and we need to determine the cost of sales amount. Okay, let's look at the information. So we're given the sales, that's fine. And then when we look at our cost of sales here, we have a question mark. So let's look at the information that we were given on information B, Roman figure 1. It says the business uses a markup of 120% on cost. That's a huge markup. So we know that our cost is 100%, and then our selling price is 100 plus the 120%, which is 220%. Okay, so that's what's important there. And then now the trade discounts totaling 336 or 336,000 have been granted and recorded, which means we know that trade discounts have an effect on our sales. They reduce sales, right? But trade discounts do not necessarily affect our cost of sales. So that is why we need to add back the 336,000 whenever we are calculating our cost of sales. Okay, so let's see how we do that. Right. So in this case, our sales were given as, okay, so that's 21,017, 200. Then we add back the trade discounts because this is a sale also, multiplied by 110 or 100. That's what we want. We want 100 over 220. Okay, what we want over what we know. Okay, that's 21,017. Okay, that's 21,017. Let's see, 200 plus 336 times 100 over 220, and then the cost of sales amount is 9706. That's our cost of sales. Then we can easily calculate our gross profit. So it's 21,017,200 minus that. So that's 11,311,200. Okay, hopefully that went well for you. And then we're going to look at our other income, but let's just quickly follow the information that we're given. So information B, Roman figure 3 is what we're looking at. It says commission income 41,000 is owed to the business. This is owed to us. Be not confused. So this is owed to us. It is income but not an expense. Okay, 41,000 of commission income is owed to us. So that's commission income. Okay, we're done with commission income. Then we're going to look at fee income, which includes 47,150 for February and March 2023. Okay, and then we are supposed to note that the fee income increased by 5% on 1 March 2023. So this is for both months, but this amount includes the increase of 5%. So we are going to say that if it wasn't for the 5%, these 2 months would have had the same fee income being received. Okay, so we know that the 47,150 is comprised of the 100% that was paid in Feb plus the 100% that was paid in March plus the 5% increase. Right now, we are going to say the 47,150 is equal to 100 plus the 105%. But what we want is the 105% only, because that is what we want to eliminate. Now, in this case, we need to just draw a timeline so we can see where our year end is. Okay, so I'm just going to draw a timeline, and we have March 2022. we have Feb 2023. But here in this case, we had March. So we had March 2023 of fee income being received. So we know then that is income received in advance, and we can take note of that because we will need to use it in the statement of financial position. So we're just going to put a highlight on this one so we can take note of it. We know that it is income received in advance. Okay, then now what we need to do, we need to calculate the 105 over what we know. We know that this is 205 multiplied by the amount of 47,150. Okay, then let's quickly determine the amount that was received in advance multiplied by 47,150, and then that is 24,150 that we received in advance. So the fee income which we were given here is this amount of 303,000. Okay, so 303 minus 24,150. So here we have our fee income 303 minus 24,150,000. Okay, so that gives our fee income of 278,850. Okay, then we're going to move on, but before that we need to calculate our other income. So we're not required to calculate bad debts recovered in our sundry income, but we cannot just simply add these two amounts and say it's our other income. That would be incorrect. We can just use the gross operating income, and then we subtract our gross profit to get our other income. Okay, hopefully that makes sense. So we're going to take the 12,253,100 minus 11,311,200, and that's other income of 942,900. Okay, then now we are still going to bag the marks that we are given, because if you can look at this, we're given our gross operating income and also given our operating profit. We can just simply determine our operating expenses at this instant. So we're going to take the 12,254,100, the 12,254,100, and then we subtract 4,150,300, and then we know that now our operating expenses amount to 8,103,800. Okay, then now we just need to work out our operating expenses, which is just these two line items, and then we'll be done with the statement of comprehensive income. Okay, then let's see which expenses we are supposed to deal with in this case. So Roman figure 5 says Bushla Ltd rents 150 square meters. Okay, 150 square meters of space from Prime Storage at a monthly amount of 330 per square meter. Okay, from the 1st of May 2022. Let's go back to our timeline. We know that, okay, let's just quickly fill this in. April, May, June, July, August, September, October, November, December, and Jan. Timelines are very, very important. Okay, so we know that on the 1st of May 2022, we were renting 150 square meters. Okay, and then the information continues to say the company increased the space rented by 25 meters on the 1st of November 2022. So from the 150, we move up by 25, which is 150 plus 25 on the 1st of November. Then now we are renting out 175 square meters. Okay, and then rent was paid until 30 April 2023. So we paid rent until April 2023. So in this statement of comprehensive income, we only want to show transactions up until here, and then whatever is outside will be the prepaid expense. Prepaid expense. Okay, which is what we will need to calculate our trade and other receivables, and we will put a note or highlighter there so that we come back to this transaction when we are working on our statement of financial position. So for now, we'll only just calculate the amount that relates to the statement of comprehensive income for the current year. So we know that in our rent expense, we were renting 150 multiplied by 330. Let's check for how many months. Since May, okay, 1, 2, 3, 4, 5, 6, before the 1st of November. So 6 months we were renting 150 multiplied by 6 plus 175 times 330 multiplied by, see the number of months. Okay, so that's 1, 2, 3, 4. Remember, we don't include the extra 2 months because those are the prepaid months. Okay, so multiplied by 4 there, and then we just quickly calculate times 4, and then that's a rent expense of 528. That's 528. Okay, then now I forgot to add up the trading stock deficits. Let's just quickly do that. So it's 2125 380 minus 2094 180. Then that's a trading stock deficit of 31,200. And then we are going to look at Roman figure 5. Let me just erase this so I can have some space. Roman figure 5 says provide for the director's fees owed. Okay, so in this case, we are given that the company has 2 directors, Brenda and Johan, that have been employed since 2020. So Brenda earns 10,000 per month more than Johan, okay, but she has not been paid for Feb 2023. We know that this is owed, so it's an accrued expense, which also affects our trade and other payables in the statement of financial position. So we also need to think about that a bit later. Now, continuing to read, it says Johan took unpaid leave for the last 3 months of the financial year. So he took unpaid leave, which means we are not paying him for the last 3 months, or we have not been paying him. So we have only paid him for 9 months. But it doesn't mean we owe him. This is just for the sake of the calculation that we are going to do just now. So looking at the information here, we are given that the director's fees are amount to 1,160,000. Okay, so it's 1,160,000, which is equal to, now we know that what's this lady, Brenda, I don't know her name, what is this, Brenda earns 10,000 more than what we, or than what Johan earns. So that's what we know at first. So we know this is Brenda. Okay, but one thing that we do not know is Johan's salary. That's why we put an X there. Okay, we're analyzing the information that we've been given. Now, plus this guy has been paid for only 9 months, so it's 9x. Okay, so remember that for Brenda it is supposed to be 11 months because she has not been paid for Feb, so it's 11 months there. Okay, so we're going to solve for x and determine what Johan has, or what Johan earns per month. So it's 1610 equal to 11x plus 110,000 plus 9x, right? So it's 160, okay, minus 110,000, and then like terms together 20x. Then let's see, that is 1610 minus 110, that's 1,500,000 equal to 20x divided by 20 divided by 20 on both sides, and then x is equal to 75,000. So this is what Johan earns. but we do not owe Johan anything. So the only person we owe is Brenda. But we know that Brenda earns 75,000 plus 10,000, right? Because she earns 10,000 more than what Johan earns. So we owe Brenda 85,000. Okay, so that's what we owe. Now we have our director's fees expense. So we have director's fees as 1610 plus the 85k that we owe to Brenda. Okay, so that's 1610 plus the 85,000, and that's 169523. Great. Then now we are done with our statement of comprehensive income, and we are swiftly moving on to the statement of financial position. So the statement of financial position on the 28th of Feb 2023. Okay, as you know, we have assets, non-current assets, so we are not determined to calculate our non-current assets. Our fixed assets also we don't calculate. The only thing we'll be calculating under non-current assets is our fixed deposit. Then we look at current assets, then equity and liabilities, ordinary share equity, and then the rest is non-current liabilities, current liabilities. Okay, and then we have a few stuff being filled out for us there, the likes of the current portion of loan, and then we just have two things to fill in and then calculate our trade and other payables. Okay, so the first things that we can deal with and not forget about, we can just look at the four first things that we've noted. I forgot to note this one, commission income. So we are going to calculate our trade receivables first under our current assets. So that's our trade receivables. Okay, and your starting point is your debtors control. That's the first point that we're going to look at. We're going to look at our debtors control 483,110. We add that directly. So it's 483,110. And then we are going to add any accrued income or expenses that were prepaid. So we know that we prepaid the fee income. You can just refer to the statement of comprehensive income. So other income that we have received in advance goes to our payables. Okay, then commission income is not supposed to be 41,000 here. Okay, because it's supposed to be 41,000 here plus an amount that we have to add from our trial balance of 277. Okay, I'm actually realizing that now. So it's 277. Right, so it's 41,000 plus 277. So that's 318. Okay. So the commission income of 41,000 was due to us, was owed to us, so it goes also to our trade and other receivables plus. And then we have some pieces of information that we haven't read out as yet. Okay, so the first one or the last one that we ended at was Roman figure 7. So Roman figure 7 says a transfer or transfer a debtor's debit balance of 2,700 from the debtor's ledger to his account in the creditor's ledger. Now let's use T account to see what's actually happening here. So let's say this is the debtor's ledger, this is the creditor's ledger. You know that your debtors increase on the debit side and decrease on the credit side, and it's the opposite for our creditors. Okay, so we then have this guy owing us 2,700, but we're supposed to transfer his account to the creditor's ledger. Now we know that when you are transferring an account, you need to close it off first, right? And we closed it off where? On the credit side. Now we need the contra account, right? Where for every debit there's a credit, for every credit there's a debit. So we've done this credit, then there's supposed to be a debit for it. So the debit is this one. So if you can see what is happening to our creditors ledger, it is decreasing. So this will affect our payables. Our payables will decrease, and here this is our debtors ledger, and it is decreasing on the credit side. So our trade receivables will also decrease by 2,700. So we have 2,700 here. That's a decrease. Then we are going to look at this adjustment for the rent. Okay, I'll just erase the highlighter to make sure that we've dealt with it. Remember, we prepaid rent, right? So when we prepaid rent, we prepaid it for the 2 months, okay, for March and April. So that calculation goes as 175. We were renting 175 multiplied by 330 per square meter for only 2 months. Then let's see what that gives. So it's 175 times 330 times 2, and that's 115,500, which is receivable. So I'll just add plus 115,500, and that's our receivables. Okay, then let's quickly calculate that. Plus 41,000 minus 2,700. See, okay, so it's 115,500 plus 483,110 plus 41 minus 2,700, and then that's 636,910. Then that is our trade receivables. Then we have inventory that we calculated. The first thing calculated on this question is 2,094,180. It's 2,094,180. Then we have lastly cash and cash equivalent, which we will determine at a later stage. Okay, so but remember that for cash and cash equivalents, the first amount you can just pay your attention to is the bank favorable balance of 629, and then any other interests follow after that. Okay, so here let's keep this in idle of 629 plus any other amounts that we will determine from our calculations or any other information, but if not, we'll just then put off the 629,000 there. Okay, so we are going to move to our non-current liabilities or current liabilities, because non-current liabilities are already completed for us. Remember, this is a puzzle. You can complete it in whatever order you like. Okay, so because you can easily, or you can simply calculate the trade and other payables, so we are going to get to that in that case. So the first thing we're going to look at is our creditors control. So our creditors control amounts to an amount of 523,890. Okay, so it's 523,890 plus we're going to look at our adjustments again. So we had the fee income that was received in advance. Okay, so we're going to take that into account. The fee income of 40, not 47, but let's look at our income statement. The 24,150, that is payable. So that's 24,150 plus this guy. Okay, it's a minus the 2,700. This guy that we no longer owe from those T accounts. Yes, this guy that we no longer owe. So we're going to subtract 2,700 from our payables, and then we are still going to look at these transactions and see if we haven't left anything out. Okay, now we know that we owe Brenda an amount of 85,000, so we're also going to add that. Okay, plus 85,000, and that's our trade and other payables. So let's quickly see. So it's 523,890 plus 24,150 minus 2,700 plus 85,000, and that gives 630,340. Okay, now let's see the last two items on our current liabilities, which I believe is on the dividends information, which is our shareholders for dividends, and then we also have an amount that is owed to SARS. If we are going to start with the SARS amount that is owed, we are given here SARS income tax provisional payments. This is what we have paid to SARS. We've paid 1,049,000, but if you have a look at the income statement, our income tax is supposed to be 1,152,000, which means we have paid less to SARS and we still owe SARS a certain amount. SARS income tax, our tax is 1,152,000, but we have only paid 1,049,000. Let me just see this amount again. 1,049,000. Okay, so that's 1,049,000. Let's quickly see how much we owe SARS. And then that's 103,000. Okay, then we have shareholders for dividends. For dividends. Okay, shareholders for dividends, we are just given that mark for free. We know interim dividends are already paid, so they don't affect our trade or our current liabilities. We don't owe anyone. We don't owe anyone. So we have our final dividends due of 2,640,000, which is which we're just going to simply add there. Okay, and then we have got our current liabilities in that case. So we're just going to simply add all of those amounts. Okay, so that's 630, 340 plus 420 plus 103 plus 2,640,000. Then that gives us 3,793,340. Okay, so we have both our current and non-current liabilities. Then now we are going to look at our equity, which is built off the ordinary shareholders' equity, or rather the ordinary share capital, and our retained income. Okay, let's see if we're given any numbers on the retained income. Okay, so retained income, we are not given any numbers, because if you could look here, we have a question mark, right? So we are going to use the piece of information, the last one that we haven't used. We are told that the debt to equity ratio on the 29th of Feb 2023 is 0.2:1. So if you don't know your ratios, please go and watch the video where I'm explaining the ratio. So the debt to equity, we know that we have our debt this side, we have our equity. So debt, we know they're talking about non-current liability is 2. Okay, so non-current liability is 2 our shareholders equity. Right, so we know that our non-current liability in this case is, let's see, it is 4,512,550. Okay, so it's 4,512,550. And then we do not know what our shareholders equity is, but we know that the ratio is 0.2:1. Okay, let's just move this working here. Okay, we'll see. So we have the 1 here. So in this case, we're just going to simply cross multiply, and we have the 4,512,550 is to, or is equal to 0.2x, then divide by 0.2 on both sides. Then x is equal to our shareholders equity, 412,550 divided by 0.2, and then that is 22,562,750. Okay, so that's 22,562,750. Right, let's look at our calculation. It's 22,562,750 562,750. Then our retained income is the balancing figure. We know that we add these two amounts to get this one. So in that case, we'll take this and subtract this to get that. Okay. So it's 22 minus 20. So it's basically 2,562,750. Okay, so we are then only left with our investment of the fixed deposit and the cash and cash equivalents. Okay, so let's look at the information that we are given here. Roman figure 8 says the company has invested in 3 fixed deposits of equal value. Okay, so we have 3 fixed deposits of equal value. One of the fixed deposits will mature on 31 May 2023, and we know if a fixed deposit matures, it then affects our cash and cash equivalents, because it then becomes a current asset, right? It becomes a current asset because we will receive it within the next 12 months, right? It matures. Now we have 3 fixed deposits, right? Let us look at our fixed deposits here. Fixed deposit 1,500,000. There's 3 of them. They are all of equal value. Okay, so it's 1,500,000 divided by 3, and we know that that is 500,000 per fixed deposit. So one of these matures, so the 500,000 then goes to our cash and cash equivalents. I'll just say 500k. So we quickly add that, and then that's 1,129,000. Okay, then we are only left with 1 million here because we have taken the other one to our cash and cash equivalent. So this is 1.5 million minus 500k. Right, then we are going to quickly sum up our current assets, so do not forget that. So that's 636,910 plus 2094 plus 1,129,123. Okay, and then our current assets should then be 3,860,990. Okay, and then that is the end of the question. Thank you so much for watching today. I hope that was really beneficial. Do not forget to like, subscribe, share, and drop a comment on any accounting questions or topics that you need help with. Other than that, I'll definitely see you in the next video. Cheers.